Afternoon, everyone. On behalf of the Water Leadership Group, I want to extend a warm welcome to all of you for today's webinar, Wildfire Risk and CAT Modeling, Insights and Property Market Outlook. As risk managers and risk professionals for water and wastewater utilities, you know better than anyone the scale of the challenges we face. Wildfire risk has become one of the defining issues of our time, impacting not only our communities, but also the resilience of critical water infrastructure. In parallel, catastrophe modeling continues to evolve, shaping how insurers, reinsurers, and utilities assess, price, and transfer these risks. Understanding both the science and the market outlook is vital for navigating today's complex risk landscape. This session brings together perspectives from both academia and the insurance marketplace, two vantage points that, when combined, can provide powerful insights into challenges ahead and the opportunities for stronger and smarter risk management strategies. We're honored to have with us two distinguished speakers who bring unmatched expertise to this discussion. First, we have Dr. Lori Matters, PhD, CPRO. Dr. Matters is Joseph F. Freeman Distinguished Professor of Risk and Insurance and Chair of the Department of Finance, Banking, and Insurance at Appalachian State University. She brings decades of academic consulting and leadership experience, including serving as chair of Florida's Commission on Hurricane Loss Methodology, where she oversaw standards for hurricane and flood loss modeling. She also serves the American Risk and Insurance Association as chair of its Risk and Insurance Teaching Society. Beyond her scholarly achievements, Dr. Matters has been a trailblazer in advancing water sector risk education, leading the nation's first professional designation program for water risk professionals. Joining her is Patrick Park, Executive Vice President, Property at Amwins. Patrick brings over 2 decades of experience spanning engineering, underwriting, and brokerage. He began his career as an engineer at FM Global, grounding his work in the technical realities of property risk. He went on to underwriting roles at Swiss Re and Liberty Mutual, managing complex and large-scale placements. And today, he leads Amwins property practice from their Irvine office. Patrick specializes in the design and placement of complex shared and layered property programs, giving him a front-row perspective on the property insurance market's current dynamics. Together, Dr. Matters and Mr. Park will help us connect the dots between wildfire science, catastrophe modeling, and the realities of today's property insurance market. As we do with all our educational webinars, at the end of the presentations, we will have an interactive Q&A session. We encourage you to engage fully, ask questions and share your experiences, and take advantage of the collective expertise in this session. So while the session is going on, please feel free to submit your questions through the chat function. With that, please join me in welcoming our first speaker, Dr. Lori Matters.
Thank you, Vlad. I'm so happy to be here with you today. I'm apologizing in advance that I have a little bit, you might notice I have a little bit of a technical problem with the slides. Are you all able to see the slide deck right now, Vlad?
Yes, thank you.
If I advance that forward, are you at least seeing the next one, even though we're in the wrong mode?
It's working well. Thank you so much, Lori.
Okay, so my apologies to everyone. We're gonna move forward in sort of outline mode because my connection with Teams seems tenuous on the presentation side. So, but we'll go ahead with what we've got. So what I've been asked to do today with you is to talk about how the LA fires are impacting catastrophe loss models, and then in turn, a little bit about how that impact might play into the actual loss estimates that the models come up with. And then Patrick, of course, will move on from there and talk about the insurance implications. So first, I don't think it comes as a surprise to anyone that global insured cat losses reached heights already this year. Actually, first-time heights. So we reached 80 billion in losses in the first half of 2025. And when you think about the wildfire losses in the LA area being 40 billion, you get a sense very quickly that not only does that put us globally above trend for the year, certainly for the first half of the year, but it puts us above trend for the entire year. But that means that those LA wildfires represented half of the first half of year losses globally. So that obviously is largely due to the LA wildfires. And so far, 2025 was the second costliest first half of a year ever in history globally. So if we move on from that and we just look at wildfire instead of global insured losses, if we just look at wildfire itself, you can see over to the right, and I hope that you can see that okay, that the Palisades-Eaton fires in the US put us at the highest, the costliest year ever for wildfire. And that's by far. So that bar chart shows you that this is by far the costliest year ever so far. And previous years where it's been closer than other years still are only about half of what we've seen this year. If you can't see it really well, there's a lighter green shading for what's happening in other countries versus what's happening in the US. And you can see that in most years, US is responsible for a disproportionate and very large portion of wildfire loss globally. So that all kind of comes together in a way that in the last decade, wildfire catastrophe loss models have become much more important to insurance pricing and even just looking at exposure aggregation, exposure management. So we've had sort of four things come together that I would say have contributed to that. Rising wildfire losses, which we just discussed, increased exposures. So there's more property that's located in the wildland urban interface areas. And of course, we know that inflation is driving up replacement costs. So we have more locations in high to very high wildfire prone areas, as well as inflation driving up what replacement and reconstruction costs are. In addition to that, we've got climate change and the complexity of wildfire behavior. Wildfire behavior is still, I wouldn't say that there aren't parties out there that understand it fairly well, but we are still increasing in understanding. Our understanding of the complexity of wildfire behavior and therefore wildfire losses is still increasing at a pretty rapid rate. That means every time the models respond, they can make some decent improvements. If we already knew more, the improvements would be. And then we also have market volatility, specifically in California. I don't need to explain that to anyone on the call. We have insurance market volatility that leads to a need to really try to get the problem under control. Well, how do catastrophe models help in wildfire risk management? So a few things to consider here. They really give us better risk assessment. They give us a better way to do risk-based pricing.
Oh, I didn't get it.
To promote resilience, to stabilize the volatility of the markets, hopefully, and to inform policy decisions statewide. In California, we now have the Sustainable Insurance Strategy, and in a portion of that strategy, catastrophe modeling, catastrophe loss modeling specifically is now being allowed to be used for rate making, but an insurer that wants to use it needs to be using a model that's been approved through the PRID process, and that insurer needs to commit to write at least 85% of their California market share in high-risk zip codes. And the commissioner would determine what those high-risk zip codes are and therefore whether that insurer's complying with that commitment. And there are already, as of August, 3 models that have been approved in that PRID process, Verisk, as well as Moody's and the public model. So when we think about catastrophe loss models, and I'm not going to spend a long time on this, I promise. If anyone has a question about the particulars of how a catastrophe loss model works, I'm happy to talk about it all day long. I enjoy it. It's a big part of my life. But suffice to say here, without extra questions from you, that a catastrophe loss model is just a series of simulations. And these simulations are going to inherently arrive at the wrong number. They're going to arrive at wrong estimates. You can't simulate a system and arrive at an exactly correct estimate. So we're forgiving of the models in terms of the numbers they arrive at. Where we don't want to be forgiving is the process they use to get there. So we pay attention to a model's process. That's what the approval system in California is doing. That new PRID process is really walking through a model's process of how it goes about the simulation and not demanding that the model arrive at the exact right number. No model would ever get approved if it needed to arrive at the exact right number. So when we think about how is a simulation then different from other analytical methods like just regular actuarial science, the main thing to know about the catastrophe loss models is that they're forward-looking, while traditional actuarial science is backward-looking. So traditional actuarial science is going to look at historical losses, and it's going to do a statistical analysis to determine whether those historical losses are trending up, down, what's causing them to trend. And so it would look at what factors are in play that might make losses trend up, trend down, and it would create some loss relativities around that to try to determine how particular factors make losses go up or down. The simulation process that we do in catastrophe loss modeling is more complex in the sense that we do look at statistical information. So we do look at historical information, but we also look at other factors. And so I just want to give you a picture of this. There are inputs we take in. We do look at statistics. We look at historical loss data, but then the catastrophe models also look at the scientific hazard process. In other words, think about this as the probability of an event. So it takes into account the probability of an event given the area you're looking at and all the specifics of that, of the physical layout of the area. And then it moves through an engineering module where it's looking at the built environment that's in that area that you're running the model through, and looks at the vulnerability of that built environment and the terrain. So the natural terrain as well as the built environment to the hazard as the hazard moves through that area. So in our case, the wildfire. So first we look at the hazard, probability of a wildfire occurring in a particular area or set of areas, and then how vulnerable the built environment is to that. And then we move into the financial space, which is the actuarial piece of this, where we're looking at then how does this play out in terms of how it runs through an insurance policy that's covering wildfire, and what does that mean from a financial loss standpoint. So ground up losses as well as the losses that are actually going to be paid by the insurer and reinsurance industries. And so you end up with, as you move through the hazard engineering and financial portions of this, you end up generating events based on probabilities. And again, I don't want to get too technical. And then looking at how intense the event would be in that locality. Then you're looking at the exposure data that was input by whoever is running the model, whether that's an insurer, a reinsurer, or some other entity. Then looking at damage estimation based on the vulnerability of the built environment in the engineering piece, and then subjecting all of that information to the insurance policy conditions and the insurance policy terms to figure out what the insured loss calculation would be. And the outputs from the model, the three big outputs that really get the most attention and are probably most important from an insurance rating standpoint, are average annual loss, exceedance probability, and tail value at risk. And the easiest way to describe these is just to say the average annual loss is a long run expected value. So it would be the average you would expect, given that we're not assuming a wildfire occurs in a given year. So let's say we're looking at 2026 and we're looking at the entire state of California. if we were doing a model, running a model where we're looking at that, then average annual loss would represent the long run average amount of wildfire loss we would expect, given scientific assumptions, given assumptions about the built environment, and given historical losses, the average long run losses we would expect if we were to look at it over many, many years and take the average over many, many iterations of many years of looking at it. Then the exceedance probability moves from that and says, okay, what's the probability that we would exceed some bigger amount? So a big aggregate amount, for instance, that we might be concerned about exceeding, what's the probability that we exceed that? And we look at, this is where you see critical values like, is it a 1 in a 100 year event or 0.01 probability? Is it 1 in 250, 1 in 1,000 year kind of event? And then the T-bar, which is the tail value at risk, is simply what would that average amount be if we went beyond that big number that we're concerned about. Okay, so the raw data that you need to put in to get out decent information would include physical conditions that help us predict fire and fire behavior, asset and property traits or characteristics so we can estimate the vulnerability and the damage, the historical data or the statistics so we can calibrate the model to see how well it is predicting based on whether it predicts what would have happened, what did happen in the past well, and then mitigation information. So any loss reduction things that should help in achieving loss savings and calibrate that as well. So within these 4 areas of raw data, I'm just giving you examples here of more specific data you have to put in. And just to give you an idea, there are thousands of types of input that would go into a wildfire model. So you're just seeing the general categories. You're certainly not seeing it in detail. And then the LA wildfires in particular, because we just noted how big they were, the historical level of loss, hopefully are now statistically, as historical loss, going to provide a lot of good calibration information and provide the modelers with a lot of good information for how to improve the models or change how the models work going forward. So we certainly can expect to see that. One of the things that's noticeable very quickly is that wildfire as a peril is fundamentally different from other major catastrophe perils, and that's going to give us some really invaluable insights that will help move the models forward. So some of the things that we saw with the LA wildfires, weather conditions were, I hate to say just right for this to happen. There were historic winds, there was suppression overload, meaning multiple fires set off across the region simultaneously and really overloaded the system. And then emergency response, and I'm not saying they weren't as prepared as they should have been, but they weren't fully prepared for what happened. So some of the things very quickly from just doing field work after the fires that the models and modelers can now take into account is shadow effects and fire breaks worked. So if you had a building or a string of buildings that were well defended, then not only did those buildings hold up well, but they actually served as protection for buildings behind them on the other side of the fire to keep urban conflagration down so that we saw less spread than we would have otherwise seen. And then also fire breaks similarly. Features like parks and golf courses and wide streets really served well, as the models actually hoped they would, to create boundaries for a fire to stay within. Okay, house-to-house differences also came up. You can kind of guess what some of the differences would be, but I want to make the point here that the conflagration was a significant factor in losses. And so as we saw differences in houses that caught fire more easily also created more spread of fire. And for instance, in Eaton, 75% of the properties within that fire perimeter were rated low to moderate wildfire hazard, but they had a high conflagration hazard, meaning they had a higher hazard of spreading fire if they did catch fire. And so 84% of the impacted structures in Eaton fell into this category. Low to moderate individual fire hazard, but really high risk of spreading fire if they did catch fire. Another thing that was really notable from the LA fires was smoke, landslide, debris removal, and the contribution of those to the overall cost. It was higher than expected, higher than had been estimated previously, so it was underestimated. Another notable difference that we see is that in wildfire, and the models did know this, they just underestimated the impact of this. Wildfire's physical footprint being much different from that of, say, a hurricane that's much better understood by the models today. The footprint of a hurricane is tighter, but the actual loss that it can produce within, say, a square foot is higher. And so, in fact, I would liken it a little bit to the difference between a hurricane and a tornado. You don't expect a tornado to hit as wide a swath of properties as a hurricane would, but if a house is unlucky enough to be hit by a tornado, the average damage is going to be much greater on average than with a hurricane. And we see something similar happen with wildfire. It's not exactly the same as the tornado to hurricane comparison, but that does give you a good sense of it, that there is a difference in how that footprint works and how the intensity within the footprint works to create loss. An area that's harder to understand within this is that when we think about what this means about aggregate losses, if we look back at average annual loss in comparison to, say, exceedance probability and exceedance amounts, wildfire doesn't have as much variability from its average annual loss to what its big exceedance amounts would be. It's say its 1 in 100 year loss would be closer to its AAL than a hurricane's would be. But the average annual loss from a wildfire could be worse than that of a hurricane. So the models did underestimate how much total loss that could represent and how quickly we could arrive at a very small probability exceedance amount. Not a surprise to you all that the risk portfolio is changing dramatically in California, and that made it hard for wildfire models to have possibly predicted how much loss there would be. We have an increasing insurance gap because of non-renewals and because of the FAIR Plan being asked to take on more policies. And this is happening so quickly that it's very, very difficult for the inputs in these models to even keep up with the size of the portfolio, for instance, for the FAIR Plan. Okay, summary and broader implications. So basically, learned from the LA fires that wildfire complexity creates a risk that is harder to understand than they even thought it was. And they already thought that it was hard to understand. So the risk was underestimated, unfortunately. The urban conflagration risk, in other words, fire spread from building to building, was worse than they thought it would be on average. And human behaviors, not surprisingly, leading to more fire probability, higher fire probability than was originally estimated. Those are all noted in the study in the aftermath of the LA fires. So this is probably going to lead to basically new generation models, in other words, innovative models that can look better at the conflagration risk, so look better at fire spread from property to property. More specificity, where now the models are going to get tighter like they have in flood and hurricane to be able to look at individual buildings. In other words, get more granular from the zip code level, get all the way down to a building level. Keep in mind when they do that, that might be more precise, but they're going to lose accuracy. They're going to have more volatility in the results. So I know that sounds weird, but these are going to be more precise models that we can expect to have more volatility. And then a renewed focus on secondary perils like smoke and debris removal, and a sharper measurement of loss savings that can be gained from what we call secondary modifiers, secondary characteristics, or loss reducers. I don't want to run out of time, so I just want to give you a couple of the broader economic indicators from this. One of what I think are most important is that unemployment insurance claims went up right after the wildfires in LA. Wages went down, so we had wage losses, which of course is related to unemployment claims going up. The probability of a municipal budget deficit after an event like this goes up by at least 25%. And so even with the municipal and county budgets, the probability, I'm not saying that the actual deficit went up by 25%, but what I'm saying is that the probability goes up by at least 25% in a loss of this size. And I'll end with the fact that the LA County mortgage payments that were in delinquency shot up quite sharply between December and February. So obviously related to the fires, because in LA that happened, while in Ventura and Orange counties, those delinquency rates actually went down during that same period of time. So we do have a control there that we can use to tell us that that's what happened. And then I'm happy to take questions too, didn't get to this in the presentation, around concerns about potential litigation related to remediation of toxic chemicals from the burned structures, as well as the impact of chemicals on the water quality. And with that, I'm going to turn it over to Patrick.
All right, can everyone see my slides?
Yep. Thank you, Patrick.
Well, hello. First off, thank you, Lori. Candidly, I have a love-hate relationship with modeling, but as everyone can tell, modeling is very critical to all the underwriters and brokers like myself. So anyways, we'll get started. I'm Patrick Park, property broker with Amwins, and I'll be guiding you through today's discussion. We obviously know wildfires are not just an environmental issue. They're reshaping property ownership, insurance markets, and financial security these days. So over the next 20 minutes, we'll quickly go over the latest trends we see in the wildfire risk, what property insurance does and doesn't cover, how to reduce both your wildfire exposure and your premiums, what to do if you live in a high-risk wildfire zone, or options for shrinking coverages, and also we'll also touch upon the property insurance landscape for 2026. So let's start with the risk itself. And I apologize if some of this is redundant to what Lori had covered, but kind of summarize what Lori has said here. So in the past decade, wildfires have burned an average of 7.5 million acres annually in the U.S. Losses to homes and businesses are in the tens of billions, and record losses in the last 5 years, which I'll go into a little bit more detail next year, have been astronomical, which has led into the last 6-7 years, the longest hard market we've seen in forever. States like California, Colorado, and Oregon are seeing both higher frequency and greater severity of fires. So this chart here shows the increased wildfire costs over the last 40 years. Where I want to focus on is this bottom half right here. The last 5 years, again, these numbers here don't even include the Palisades and Eden numbers, but from 2020 to 2024, there's 5 events that are over $1 billion, and that equated to $43 billion. When you look at the previous 4 or 5 decades before, and you see the increase of loss activity or the loss amounts. So there's clearly been a shift in the wildfire landscape. And now down here, you see the rough estimate in the last 40 years, about $148 billion. Coming from the carrier side, when I was an underwriter, wildfire was not something we even modeled until 2021, 22. That wasn't even factored into the costing. So it's interesting how the last 5 years has completely changed how property underwriting is being done throughout the country now. This chart here shows the historically, the second half of the year has the largest wildfire activity. what's interesting is the last large one we had in California, Palisades and Eaton, that was in January. So we've come to the conclusion wildfire is an annual cat peril now. There's not really, it's not like hurricane season when you have June, July, August, September, and October as the peak months. Fortunately, wildfire is almost year round. And these spikes here reflect some large losses. I believe this purple trend here was a combination of the Woolsey, Camp Fire, and Mendocino fires. And then the 2020, which one is that here? The orange one right here, this spike was the August complex fires, which was over 1 million acres that went up in flames. And then 2021, the green line right here, that was the Dixie fire here, which was about 963,000 of acres that were burned. You know, I think it's no surprise, obviously, you know, I think everyone here sits in California. We obviously know California is the highest exposed state from wildfire, but it's interesting to note, you have all these surrounding states here that also have considerable amount of wildfire activity. The one that surprised me the most here is down here in the Southeast. I would have not thought Georgia, Tennessee, Florida would be even on this chart here, but nonetheless, it's becoming, I think it's wildfire is a peril that's pretty much going to be throughout the entire country. These charts here show some activity from the 70s, 80s, and 90s here. And you know, in the 70s, 80s, it doesn't seem like there's too much difference, but as I'll show you as we get into the 2000s, you'll see the increased areas of California that have wildfire activity. And the trend is clear that each decade, there's more and more activity. Right here. And then this last one right here, you see an overlay of the last 40 years. So it's tough when you have risks that are placed in these areas or even adjacent to these areas. The property insurance markets are quite punitive. But I will share some good news toward the end here. But all right, so what's driving all this? It doesn't take a rocket science to figure this out, but obviously we have much hotter, drier conditions. There's more development from personal homes and from businesses in wildland, urban areas of the state. You know, we commonly see homes, public entities, wineries, hotels, hospitalities in areas where they historically have not built, and so now you're adjacent to high risk vegetation areas. Then we also have aging infrastructure, such as old combustible wood frame building that is much more susceptible to catching on fire versus a non-combustible building, or even a newer building that has proper fire retardant coverings on the structure. Then we also have more ignition sources. Some of that's attributed to the fact that some of our utility companies have not done a great job with maintenance. So all this translates into higher premiums, non-renewals, and in some cases, insurers leaving entire regions, as we recently saw with some of the large personal lines companies this past year. So let's go over quick a few coverage caps, and there are more, but I just want to highlight the main ones here. From a coverage standpoint, standard property policies typically cover fire, including wildfire. So that means your buildings, your personal property, business interruption, all of that would be covered under a loss. But there are limits, and some insurers also cap out the payouts. Some of the gaps that we typically see would be underinsurance. Rebuild costs are often underestimated. Then there's also these low sublimits or exclusions on secondary structures such as random sheds or detached garages, miscellaneous smaller locations. Typically, we also see higher deductibles in wildfire-prone zip codes. I mean, deductibles usually start at minimum 100 to 250,000. I've seen it as high as $1 million. And some large clients will even take on larger tensions up to $2.5, $5 million. Policies may also exclude loss of rent, business interruption, or landscaping damage. So it's all very important that everyone, all the buyers at the end of the day, are reading the fine print on these policies. So here's some good news and some proactive steps that everyone can make to make a difference. When I'm broking a deal, one of the things that we always talk about is defensible space when we're talking to the markets. So clearing 30 to 100 feet around your property of any sort of flammable vegetation, it makes a huge difference. In fact, this may sound funny, but this is absolutely the truth. There are some of our clients that use actual goats to eat away their nearby vegetation, and we highlight that to our underwriters, and they love hearing that. That shows that proactive loss prevention philosophy for a typical insured. There's also fire-resistant materials such as metal roofing, ember-resistant vents, dual-pane windows, and there's also if we have clients that are very active in loss control, where they have some sort of human element program, where it's encompassed by the entire all the members in a pool. We use that to help reduce, not only to reduce the neighborhood level risk, but also to sell a story to our underwriters of all the positive attributes, positive things that our clients are doing. So at the end of the day, what does this all mean? Right? Currently, right now, insurers are beginning to offer some premium credits or policy renewals for properties that meet these mitigation standards. And some of these carriers are now starting to use satellite imaging to check compliance as well. If you think of it this way, if you can reduce the chance of your property to be part of some claims pool, you're much more attractive to insurers. How can an insurer differentiate themselves from the rest of all the other submissions out there? I also wanted to add a comment about the AALs that Lori was talking about. So the AALs, there are a lot of numbers, right? The average annual loss expectancy. What underwriters and brokers do, we use these numbers basically to calculate premiums. Usually the AALs are multiples of, usually the premiums are multiples of the AAL. And that fluctuates depending on the exposure. So we at Amwins, one of our key things that we do on any sort of natural catastrophe exposed account, we model all perils to understand what types of AALs the underwriters are using to come up with their premiums. That way we know what they're using and we can help negotiate the best terms and price. And obviously we've all heard insurers pulling back. Some of you guys may have faced this on your personal home. This unfortunately continues to be a growing trend. So what happens if carriers keep backing out? So there's some options out there. And so the options, if you can't get traditional coverage, would be using a state-backed FAIR plan, like the California FAIR plan, which it's usually one of the cheapest options, but it's a very bare bones policy. And I view it as a last resort solution. Or you go to your surplus lines markets, the excess and surplus lines. Typically, they are more expensive, but often available when all the big admitted carriers leave. And also, they're able to get a lot more creative using wildfire deductibles and sublimits, where the standard markets, such as your AIGs, Travelers, Liberties of the world, they can't do that because they have filed the rates and forms. So the Commissioner of Insurance does not allow for that sort of creativity. And another hot solution that we're seeing more and more is the use of parametric insurance. And this not only applies to wildfire, but applies to, you can have a parametric solution for flood, named hurricanes, convective storm, pretty much anything. But the payouts are triggered by fire size in the event of a wildfire or proximity, but not necessarily for a damage assessment, which is typically what a traditional property insurance policy would be. There'd be a lengthy claims process as well as an adjustment period. But the beauty of parametric is that if you have the event that's triggered, you get a payout immediately. So there's literally no adjusting period. It's a quick infusion of cash. All right, so what can we all do to make sure that our clients get the best property solution out there? So the first thing is, do a full thorough coverage review, go over your limits, get creative with deductibles, use a shared and layered quota share panel versus a single carrier to have leverage in the market. And I'll actually use an example, partnered up with Lad on his the East Bay Mud opportunity. If I recall correctly, that deal was placed 100% with AIG, and they had some wildfire exclusions. When we went to a quota share and shared and layered panel, we ended up having, initially I think it was 5 markets. And because in a shared and layered panel, each market takes a small portion. So that one is roughly, let's say 20% of the exposure each. They tend to get a little bit more open-minded and willing to add some higher exposed locations versus when you're with one market, AIG, putting up the full, I think at the time was a $300 million limit. They're going to be much more selective and will push back when they feel like their comfort level is much lower when you place all your eggs in one basket versus placing your eggs spread across multiple carriers. Also, I highly advise you guys to all consult with your broker. Coming up with a good story along with very good what we call COPE information, which is basically just construction, occupancy, protection, exposure. That helps a lot for a broker like myself to get the best terms and price. There's also discounts that can be applied, and that mitigation discounts, which is all part of the story on what our clients are doing on the ground in terms of making sure you have good space separation, getting rid of all the vegetation, emergency response plans, stuff to that nature. And then again, I'd also say as a backup option, definitely explore a parametric idea too, because what we've seen in the parametric space is if you can offload the wildfire exposure to the parametric markets, then you can get a property policy that excludes wildfire. Having said that, that can only be done in the excess and surplus markets. The retail markets, again, cannot do that. They do not have currently a definition for wildfire peril. It's all lumped under a fire. So a retail policy is 100%, it's a fire policy. So you can't exclude, there's no delineation between normal fire and wildfire. Am I doing on time? All right. So this is probably what everyone wanted to hear talk about here. It's the 2026 property market forecast. So the overall property market is softening, and next year should be favorable. But there are a few things I do want to point out, depending if the risk is placed in the standard markets or the E&S markets. And by standard markets, I refer to it as retail markets as well. So what we're seeing right now in the standard markets is that they're not as aggressive as E&S markets and not as flexible, as they have less levers to use when negotiating a deal. So we have been seeing rate decreases around mid-single digits, assuming that the risk is considered a top-tier account with a clean loss history. Excess and surplus markets, there's been a ton of influx of new capacity entering this space. New MGAs and markets and new products are coming in, and we're averaging right now, the starting point tends to be a -10 to -15% rate decrease. Lastly, the reinsurance and fact treaty side. So I reached out to a few friends of mine on the reinsurance side, and they're estimating renewal discussions starting January 1st to start off at about -10%. I've recently started seeing facultative markets dipping into the primary layer, which is the layer right above the deductible, which tells me that the reinsurance markets have been profitable, so they're getting more aggressive. The last 5-6 years, I don't think I've ever seen the fact markets drop that low. They're usually sitting above a primary 10 or primary 25. They don't want to trade dollars, but the fact that now that it's starting to get into the primary, that means the reserves have gone up and they're making money. So that's all. It's a long-winded way of saying there should be good solutions out there for all the buyers. That's about it. But in quickly closing, I know I covered a lot there. Key takeaways are wildfire risks is increasing, unfortunately, and insurance is adapting, but it's not always in your favor. The E&S market is here to be agile and nimble and try to find a solution that works for our buyers. Standard policies cover wildfire, but there are gaps, unfortunately, within the standard policies. Risk mitigation protects your properties and can also save you money. Even if insurers are pulling back, there are still options. So please work with a broker that is well versed in wildfire to help craft a strong story to deliver best terms and solutions. That is it. And then I'm not going to go into, there's an appendix that I've attached that has a lot of great pictures and charts. And I think Lad will distribute, you guys can go over it. This is one of my favorite charts. All of our clients love this chart. Kind of shows over what all the huge events we've had this past year. So I think that's about the time I had. So thank you, everyone.
Thank you, Patrick. Yeah, we will definitely distribute this presentation to our members. With that, I think I saw a few questions pop up in chat. Chris, can you please go over the questions that you've received so far?
Yes, the first one is for Lori. Are you seeing, hearing, or experiencing modeling changing with other CAT models, for example, flooding, from the broader weather changes occurring?
Absolutely. So we're seeing, thank you for that question. We're seeing model changes occur in all perils, and I would say we're probably seeing the most monumental changes, less so in hurricane wind than in flood, wildfire, other convective storm, like tornado and hail, and secondary perils. So we're seeing a lot of change in those, less so in hurricane wind.
Thank you. Second question is for both Patrick and Dr. Metters. Do property carriers have their own models, or do they share wildfire models? And then the second part of the question is, how similar or different are the models from each other?
I'll take the first step. So yes, property carriers do have models. Some of them have their own proprietary models. The vast majority use a combination of either the AIR model or the RMS model. And your second, and I forget what the second question was.
The second part of the question is, how similar or different are the models from each other?
You know, at Amwins, we use only, AIR is the only one that does wildfire modeling. So I can't really speak on behalf of that, but when you look at other perils such as earthquake or hurricane modeling, we have seen a vast difference between AIR and RMS, and that's just simply based on what factors and what tweaks they've made to the model. I'm sure Lori can probably speak much more eloquently on that stuff than I can.
No, I mean, I agree with what Patrick just said. So what we see is the modelers have different assumptions. So when you think about the inputs that go in, they make different assumptions. And without getting into a great deal of detail, if you look at Verisk, which is AIR, or you look at Moody's, which is RMS, they have different expertise. So they put a little more emphasis on different pieces, different of those modules. So like there's the hazard module and that engineering module and the financial module. And think of it like this, that each modeler will have their own kind of signature, like we're really, really good on the engineering, or we're really, really good on the financial, or we're really, really good on the hazard. And so that impacts how that model plays the story out of the storm season, right? Or the wildfire season. And I think the most telling thing about this, and why your question is so apropos, is that if you have just what we found in research is that if you just have one little assumption that's off, let's say by 1 unit of whatever, that can throw the loss numbers off by 4 units, so 4 times. And that's just one assumption. So when you think of the thousands of assumptions and inputs that go into a model, it really can make quite a difference in the loss estimates that they produce.
And Lori, just to follow up on your presentation and this question, you also mentioned that the models are about to get a lot more granular. Do you think it's going to impact both of the wildfire model approaches, or is one going to be more granular than the other? So how do we navigate this? And do we, like, if we're in a market for insurance and we're getting some undesired responses from the carriers, can we ask them to look at a different at the second model instead and see if that changes their approach, or are they ultimately committed to one model and they will only use one model? So sorry
Yeah, so
to make it a complex
No.
question. Maybe
No, I was
Patrick.
about to say there are a lot of really good questions in that question, Vlad. Super questions. So they are going to get, I think let's say, and Patrick's spot on about this, that this is primarily AIR and RMS. In every catastrophe peril, those are the two modelers that are the most active, that have the biggest market share with the insurers and the reinsurers. And so, if we step away from proprietary models that a carrier might have, those are the two commercial modelers that have the biggest market share. So those are the two that we typically look at the most to see what's going on with the modeling. They're both going to get more granular in wildfire as well as other perils. They're already just crazy granular in flood. And my biggest concern about it is that, given in very high risk areas, I don't know that you can really charge most people the risk premium without subsidizing the premium anyway a bit to help it make it more affordable. And so if you start getting super granular, right down to the property, I think the problem we run into is very quickly we have unaffordable premiums, and then you're kind of forced into these subsidy situations, and then are you transparent about the subsidy or not? So I think because of that, there's going to be a lot of competitive pressure, not for the insurers not to use the models so granularly. And I don't know over what period of time that I think that they will use them that granularly, but I know in the short run, it probably doesn't serve the insurer's best purpose to use them as granularly as the technology might allow, because of how much it would throw off the affordability of the pricing and the volatility of the loss estimates. So, in other words, trying to be so precise, you end up with a lot more incorrect outcomes.
Yep.
Yeah, and so I think, to your last question, I think that they're probably going to want to continue to use blends of models. I think blending the models, like blending AIR and RMS, is smart. That's just a smart thing to do. If you're concerned that one, in a given year, in a given iteration of in a new version of their model is going to get maybe too precise and have too many errors in that desire for precision, that it makes a lot of sense to blend the models so that you can at least mitigate that problem.
Patrick, a follow-up on this. If one of our members, let's say, have a pumping plant located in a high hazard zip code, how can they highlight their best practices and what they are doing to basically guard that asset, so that they get some acknowledgement or credit for going above and beyond what the model says it should be priced at?
Yeah, so what I would say to that is having some sort of corporate document that talks about like an emergency response plan. What the underwriters want to see is that the insured has put thought into their exposure, right? And insurance is there as a backstop to indemnify them in the hopefully unlikely event of the wildfire event, but they want to see some proactiveness. So like I said earlier, have they made sure that all the vegetation is cleared away from their structures? What else are they doing to be proactive? Are they adding sprinklers on? I've actually heard there's now some folks that are adding like misters, or they're pre-wetting their structures, the roof, so that they don't have embers that could potentially start a fire. But yeah, that's what they're looking for, that proactiveness from a risk control standpoint.
I see. Okay. So there is a way to demonstrate and communicate that.
Excuse me?
So there is a way to highlight that,
Yeah,
and hopefully
absolutely.
get a better.
Absolutely.
Okay.
Absolutely. But I mean, at the end of the day, we're not talking about, if that risk is going to be $100 now with a good story, I can't get it from 100 to 20. I mean, we'll probably shave off, we're talking 10, 20%, because at the end of the day, the markets still need their premium. But the one thing I wanted to add to the prior question on the modeling aspect is, so you have these models, and some of them, like I said, some of the carriers also have their own proprietary model. But what the model does not account for is the aggregate exposure on that carrier's portfolio. That's the one thing that even as Amwins, we don't know how much wildfire exposure is in that zip code for that particular carrier. So let's just use an example. Berkshire Hathaway has, they're doing billions in this particular zip code. They might be capped out. So now this, if they want to deploy more capacity, there's going to be a huge premium. It's kind of like the easiest analogy to use is when you're flying on an airplane, the first 20 seats, it's probably cheap. But as they get filled up, the last 5 seats, they're charging multiples. And it's kind of how a lot of cat exposed premium is allocated or capacity is allocated. So, and that's something that the models cannot take into consideration.
Thank you. Chris?
Looks like we have one last question for you, Patrick. How do you reconcile the largest wildfire losses in history with the softening property insurance market?
So the large Palisades and Eden fire we had in January, most of that was all attributed to personal lines. So in the commercial space, we haven't seen much impact. In fact, in some of our July renewals, we're still delivering anywhere from 5 to 9% rate decreases on accounts that had large, $10 million losses. But the only way we were able to do that is because these had a syndicated program where you had 20 to 40 markets on a deal, and we leveraged it against the new markets that would come in. We leveraged it against the incumbents that paid premiums. And so we're in this new market where underwriters and markets are desperate for premium because we have an abundance of capacity, which then shifts the pendulum back to the buyer side, and we can now negotiate and get better terms and best pricing. Whereas the last 5 years, we were at the mercy of the markets because there was a shortage of capacity, and you had all the hurricane events, all the wildfire events. So folks are pulling out of certain peril areas, and so we had to use whatever capacity was available. So like typical economics, when there's a shortage of supply and demand goes up, well, then price goes up. But unfortunately, that's changed. And barring $100 billion plus natural catastrophe event, the market should still be in the buyer's favor going next year. Does that answer your question?
I think so. Thank you. Thank you so much,
Yes,
Patrick. Thank you, Lori. And thank you, everyone, for joining us today. We're at the end of our webinar. We've covered a lot of ground in this session, from evolving science and methodology behind CAT modeling to the realities of how wildfire risk is shaping today's market. Together, these perspectives, I think, help us better understand not only the threats that we're facing, but also tools and strategies that we have available to manage them. And once again, special thanks to our speakers, Dr. Lori Matters and Patrick Park, for sharing their insights and expertise. We're looking forward to seeing you next month for our open forum. And we will be announcing our next educational webinar in weeks to come. Thank you very much for your time. We really appreciate you being here. Thanks, everyone. Bye-bye.
Thank you.
Thank you.